This next month is going to be a lot of fun to watch. Now, if Russian crude does go off the market, it's not like there are no consequences because, we're already in a tight market environment.
In the world before globalization, so World War II and before, there was little trading, or what existed was basically an imperial government raiding the rest of the world for markets or for resources. So we had hundreds, really thousands of different separate local economic systems, and you could only source materials from within your own geography. And so if you didn't have oil, you didn't industrialize. If you didn't have food, your population was really low. But globalization made the world safe for everyone. And so any sort of international economic exchange, regardless of what it was, could happen. And the U.S. Navy ensured that it could happen on the high seas without a military escort. That was kind of the whole basis of it. And so all of these little disparate parts started amalgamating eventually into one total global whole by the time we got to the 1990s. And when you're in a bigger pool like that, everyone specializes and everybody adds value. So you get diversification of production, you get greater bulk of production, you get a lower cost of production. And it works in every economic sector, whether it is energy or agriculture or finance. It is that diversification and that volume that is the world we understand. That's the world we've been in since 1990. And it's the most atypical period in human history. What's going on now, part with the Ukraine war, part with nationalism, part with tariffs, whether it's from Biden or from Trump, it all takes us into the same place. It breaks up that global whole. And as you do that, we lose all those synergies and all those economies of scale. And we feel that as shortages and inflation. Yep. So what we're going through right now, even if nothing else plays in, this is kind of our new norm for the next several years until we adapt to whatever. It really depends where you are, and how you feel is going to depend upon what your local geography of trades ends up being. So on the positive side, look at North America. So the United States has the best demographic structure in the world, the most stable capital structure in the world. It's the home of the global currency. Mexico is the best demography in the advanced developing world. We've got a first-rate manufacturing system. We're the world's largest producer of food and of energy products. So even if North America is 100% on its own, we're probably only looking at about a 10 to a 15% drawback. That's our entire import and export portfolio. Outside of North America. That's awkward to adjust to, particularly in manufacturing, but it's totally doable. Then Look at China. 85% of the energy comes from somewhere else. 90% of the inputs that go into their agriculture sector come from somewhere else. About half of the raw material inputs that go into their manufactured goods come from somewhere else. The medium and high quality components in that all come from somewhere else. And their export markets is how they employ their population. Yeah. So if you deglobalize the Chinese economy, you're talking about a reversion to pre-industrial standards of living. And that can happen surprisingly quickly because all of the inputs that are responsible for manufacturing are similar to the ones that are responsible for keeping people alive. So if something happens to agricultural or energy markets, that is the end of the People's Republic of China as a significant power. Well, there's a short-term issue and a longer-term issue. The short-term issue is that in absolute terms, China hasn't risen up that much. Russia was already number two, and the difference between number two and number one were small, and they regularly went back and forth. So there's a bit of a statistical play there. A little bit longer term, the crude that comes from Russia to China is not the normal stuff that you see on international markets. It's all from eastern Siberia, and the Russians don't know how to operate any of those fields. They're just beyond them technologically. So all of the production that ends up in China is actually dependent upon Shell and Halliburton and the rest, and they have now all left Russia. So we're going to get an interesting real-world experience on how fast the most technically advanced fields in the world can fall offline because of lack of technical skill. Will that be this year? Will that be next year? I don't know. But this is the end of China's ability to get Russian oil, not the beginning.
Given that there are a lot of...
It is the traditional method. I'm not saying it's not painless, but it is the traditional method. It totally can be successful. Whether it can be successful without a recession, I think, is kind of an obvious question. Considering that we're dealing with demand and especially supply shocks here, is the problem. If it was just a demand shock, if this was just us returning from COVID and starting to travel again and going back to our more normal consumption pattern, if it was just that, then interest rates probably are the tool. But there's simultaneously a supply shock. So the three big things that are going on in the world, the Ukraine war is shocking international energy and agricultural markets. Number two, China's falling out of the system. COVID is the proximate cause, but it's only one of many. So manufacturing has to reshore or at least shore somewhere else. That means we have to build up the entire supply chain somewhere else. That was going to be inflationary all by itself. So that's kind of a combined supply and demand shock. And then third, and by far most importantly, the baby boomers, the largest generation we've ever had, is leaving the workforce. And the replacements on the young side are the Zoomers, and they are the smallest generation we have ever had. So we have a 400,000 worker shortage this year, and it'll increase every year for the next 12 until peaking in 2034 at about 900,000.
Wow.
So we have a problem with our supply of labor. That is by far the number one cause of inflation this year and probably next year as well. And interest rates are useless for dealing with that. Well, a couple things to keep in mind is that demand is shockingly stable in the United States right now. We're bouncing back from COVID. Americans have more than $2.5 trillion in the bank. This is the most cash flush the American consumer has been since the dot-com bubble. So demand, even in an era of high inflation, is going to continue. Ignore customer confidence surveys. Look at retail sales. Look at what we actually do, not what we're bitching about. And that would suggest that the demand is still there. And as long as demand is still there, the cost cutting is going to be held in check because there is someone to sell to. There is someone to sell to at the prices that people have to pay now. The role for government here is very small. There may be some specific critical materials, as we've discovered, baby food might be on that list, where having a regulation for additional inventory stocks might make some degree of sense. Although with government regulation, by the time we get around to that being in place in an intelligent way, we'll probably be on to the next crisis by then. But I think this is entirely a private sector issue. Companies have discovered that if you have to wait on a part 9 months, is it really a viable part of your supply chain? And you have to find another supplier. And especially what we're seeing in the IT space is that China has now been offline for so long. Shanghai was down for 2 months. It's about to go down again. We're seeing manufacturers being forced to relocate to places like Mexico, the United States, and Vietnam, kind of the three big winners out of this. But it still takes time. And so companies are now making orders in mass for product that is not yet coming out of supply lines because the supply lines aren't yet in place. But it is providing some of the capital flow that is necessary to build up this new system. On the back end, it'll be a more stable system with shorter steps that is more economically viable, that employs North American workers, that is closer to home, that is cheaper to operate. These are all good things.
Is Russian crude. There were a lot of efforts early on in the war, especially by the Europeans, to shut Russian crude oil out of the market. All told, roughly 6 to 7 million barrels a day of Russian crude and product goes west to Europe. They are by far the primary consumer, and they are primarily in control of the infrastructure that allows delivery, so it's really hard to send it anywhere else. What you can do, however, is put it on a tanker and ship it around Africa or through Suez and get all the way to India and China, and that is what is happening. In the early weeks of the war, we did see about 1 million barrels a day of Russian output shut in. It was a very good start. But then these longer haul tankers came into play, and the Russians are more